What's up, apes? Welcome back to the Daily Peels video stream of the day. We got a lot to talk about here today, including the most boring Federal Reserve meeting of all time that might not be too boring down the line. So we'll be talking about exactly what the implications of today's nonsense nothing meeting will be for us and our portfolios, and most of all, the attempted homelessness that 𝗪𝗂𝗪 is trying to spread from sea to shining sea. We'll then, of course, be getting into some of the big stock movers of the day. Starbucks absolutely shitting its pants, just like I do most of the time after I drink Starbucks. And then, of course, we'll be finishing up with consumers. I don't even know why the government goes and asks these questions. We all like to ramble about bullshit that we know absolutely nothing about. Nobody likes to do that more than me, as you guys know. But we'll be finishing up with some consumer takes on the economic fortunes for the United States going forward. Of course, we do have a little bit to talk about before we get into all of that stuff. Most importantly, the fortunes of the Boston Celtics today, destroying the Miami Heat and advancing into the second round of the playoffs. We all knew what was going to happen. I mean, RIP to Kristaps Porzingis. Very tough to see him going down, but, the Celtics, we got a deep team right here. As much as we love Porzingis, really, I don't want to say we don't need it, but we don't need him to win the championship. I'm going to go out on a limb and say that right now. Meanwhile, the 𝗪𝗲𝗀 portfolio is also busy winning during the day as well. Now, we did lose 19 basis points, bringing us down to about a 6.61% return on the year, still outperforming the S&P and the NASDAQ, especially today. Both were down a little bit more than 30 bips because the market completely sold off towards the end of the day in the last kind of half hour or so, because 𝗪𝗂𝗪 was fucking running his mouth as always at these press conferences, completely killing the vibe, definitely killing my vibe, as if my stock price weren't doing that already. Anyway, let's go ahead and get into some of the banana bits that we have today. Excuse me. So, the first thing that we wanted to point out, because we didn't touch on this too much during our big story of the day in the macro monkey section, but Powell did come out and basically, it's Fed speak, right? Like, he's not going to come out and say anything directly, but he basically did close the door on further interest rate hikes, which was, a good feeling, but that was pretty much where the good news ended for this report, unless you are a treasury market participant. Unless you're literally Janet Yellen, that's pretty much the end of the good news here. Anyway, protests around the United States, we've all seen them going on college campuses. Who the fuck knows what's going on there? I graduated a couple of years ago, thank fucking Christ almighty. I can't imagine what it's like seeing people essentially like cosplay homelessness on a campus's green space or some shit. I really don't know what's going on there, but it's eerily reminiscent of the summer of 1968. Not that I was there, as you guys can see my stunning youth and beauty, but I'm told that apparently the summer of 68 was pretty crazy and worked out very shittily for the Democrats at that time. So, political analysts are starting to wonder now exactly what this is going to mean going forward for Big Dog Joey B and his campaign. Meanwhile, we all know Big Dog Donnie T is currently sitting inside of a New York courtroom, he's shit-talking Joe Biden on Truth Social. Funniest thing ever. He said something like, Joe Biden is in New York City today, but I doubt he even knows it. I was pissing my pants laughing at that one. Anyway, pullbacks in spending. These are not limited to just companies like Starbucks and those kind of premium products. We'll be diving into Starbucks much more so in just a second, but even companies like McDonald's and the cheaper options are starting to see pullbacks in consumer spending. So what that means for the economy, obviously not a very good sign. We'll talk about how it all ties together in just a couple of minutes. Finally, our favorite chart provider in the entire world, the Daily Chart Book. Go sign up for DC Lite. It's free. It gets you 5 free emails. This isn't a paid sponsorship or anything like that. I just fucking love it, quite honestly. They just went ahead and updated their cheat sheet for the period. So this cheat sheet kind of attempts to account for everything and anything that could be affecting the value of your portfolio. We're talking about earnings, allocations, flows, all that fun stuff. Go ahead and check that out. Spend some time reading it, even if you don't understand it. If people are kind of looking over your shoulder at your laptop, they'll think you're smart anyway. And trust me, we all know you need that. Anyway, 𝗪𝗂𝗪 speaks today. We have another 𝗪𝗂𝗪 speaks because the Federal Reserve did meet. Now, I barely even knew this meeting was happening. I kind of looked into it over this weekend, forgot about it on Monday, I guess, and I remembered late in the day yesterday. So the most unanticipated, most boring Federal Reserve meeting of all time did happen. Obviously, we all already know, what happened to interest rates. Let me just tell you that you made the exact same change to U.S. interest rates that Jerome Powell did yesterday. Absolutely nothing happened. We are still in the range of 5.25% to 5.5%. We'll probably be there for quite a while based on 𝗪𝗂𝗪's comments. So essentially, Powell came out here and said, the vibe is kind of business as usual, right? Like we saw an uptick in inflation, not enough of an uptick for the Federal Reserve and the FOMC to consider raising rates even further to essentially slow the economy. We're also not at a point where we are ready to be trimming rates, which is both good and bad. It's bad for our portfolios because rate cut makes stock go boom, but obviously, if we're not cutting rates, that means that the economy is resilient enough to be stable during this period of higher interest rates. or at least that's what the FOMC thinks as of right now. Just ask Arthur Burns and Ben Bernanke how it went, making monetary policy based on what they think. We'll see how that goes going forward, but it wasn't like the Fed did absolutely nothing. As much as that make it seem like they did, there was actually a bit of a change here, kind of underlying. Like, it's a lot less sexy than interest rates. We all know how fun and exciting interest rate policy is, but if we go ahead and take a look at the Federal Reserve's balance sheet, that's really where the fun was for this month, or for this meeting, actually. So, basically, since March of 2022, when the Fed initially started quantitative tightening, when they started raising interest rates, at the exact same time, they started to reduce the size of the balance sheet. So, to give everybody the quick kind of context, the Federal Reserve does have its very own balance sheet. Liabilities include things like dollars and bank deposits and shit like that. Those are liabilities of the Federal Reserve. Now, on the asset side of things, what the Fed does is they'll buy shit like treasury bonds and other super safe securities like mortgage-backed securities and agency-backed securities, whatever else it might be, CMBSs as well. It's all super safe stuff like that. They essentially buy this stuff to manage liquidity in the financial system. When I say financial system, I don't mean the stock market. I mean what's actually underlying with these banks and their deposit rates that they hold at the Federal Reserve institution, and what's actually going on with liquidity on the banking side, because that's fundamentally what's going to drive demand for loans and ultimately the stock market performance at the end of the day. So the Federal Reserve, essentially, before the GFC, the Federal Reserve's balance sheet, it was below $1 trillion. It was kind of trending in the direction of $1 trillion. GFC happens, they print a shit ton of money, and eventually, by 2015, we run up to about $4.5 trillion. We started to roll that off a little bit after 2018 because Trump was yapping about it the whole time he was in the White House. We did manage to run that down to about $4 trillion by the beginning of 2020. Then, boom, off to the races. Like I wish my portfolio did, the Federal Reserve's balance sheet more than doubled. It went over $9 trillion at one point, approached $10 trillion, or got into that territory at the very least, and that's completely ridiculous for the Federal Reserve's balance sheet to be that high. That means they are completely dominating the markets for those super safe securities that we were talking about a minute ago. They are the number one liquidity provider in treasuries and everything else. They're usually going to be the number one provider in any market that they're operating in, but the point is to get them to operate as little as possible because we want to let the free market reign supreme. That's kind of what America was built on. But anyway, we have seen the Fed's balance sheet start to reduce since March 2022, when those interest rate cuts actually started. At the same time, quantitative tightening started occurring, and it started by the Federal Reserve simply not reinvesting certain assets that were running off the balance sheet. So if the Fed buys a one-year treasury, once that 1 year is up, it matures, they get their payment. Most of the time, what the Fed will do is just kind of, by order of operations, it's going to reinvest to maintain a certain level of liquidity. But when you're in a policy changing point like March of 2022 was, the Fed decides, we're no longer going to be reinvesting this stuff once these assets roll off our balance sheet. So when we say roll off, that means kind of rolling maturities for a lot of the securities these guys have completely loaded up on. Jesus, I'm doing a lot of rhyming lately. I'm very impressed with myself. Shady Records, some rap label, hit me up, please. But effectively, what we've seen since then is the size of the balance sheet run down from about $9 trillion to a little bit over $7 trillion as we stand right now. This has been done in $95 billion monthly increments. We're seeing about $60 billion in treasuries roll off per month and about $35 billion in mortgage-backed securities roll off every month. Now, when you're letting these assets roll off your balance sheet, you are not actively taking liquidity out of the system, but what you are doing is not providing liquidity. And that's kind of how it should be. If you ask, in theory, if you were going to start this all over again, you wouldn't necessarily want the Fed to be participating in markets unless an extreme kind of outsized shock event happens that's going to cause a multi-decade depression. So when the Fed is letting this stuff roll off, it's not that they're draining liquidity from the system, but they're just no longer adding. And that's kind of what we got used to in the post-COVID period, so it was a big change at the time. Right now, what the Federal Reserve has decided is that they are going to be reducing that $95 billion monthly roll-off to a much lower level, about $60 billion in total roll-offs now. That was what they were doing in just treasuries beforehand. Now it's going to be the total, because the amount of treasuries that the Fed is willing to let roll off its balance sheet on a monthly basis is getting reduced from $60 billion alone to $25 billion. So MBS is staying at the exact same level. They're rolling off $35 billion a month. Add these up, it's a total of $60 billion, cutting that by more than one-third. relatively big cut. I mean, it's, $35 billion, which in the grand scheme of the financial system isn't a whole lot, but it's a step in the right direction in terms of normalizing the balance sheet and getting the Fed's bullshit participation out of these ever important markets. So in the immediate response, the 2-year Treasury completely took a dive because, like we said, it's when you're letting something roll off, you're not actively decreasing liquidity in the system, but you're certainly not increasing it. So by letting less roll off, you're doing less taking away of liquidity. I promise I worded this better in the piece, so go ahead and read that because you'll probably understand it a little bit better then. But when you're letting less of these assets roll off of your balance sheet, effectively what you're doing is saying, okay, we are going to kind of move back in the direction of being a non-participant, or at least not adding liquidity anymore. So that's it's a reduction in the decrease of liquidity, if that makes any sense at all. I could be rambling right now, but we're 10, 11 minutes into this, so I'm not going to re-record. Anyway, this essentially just means that the Fed is moving back towards a more neutral policy. Rather than quantitative tightening, we are moving closer to neutrality and kind of operations as usual, as if the pandemic never even happened. Now, of course, that's still with a bloated balance sheet with a fuck ton of money on that shit. As we all know, 40% of the USD in circulation was created over the past couple of years. Like we said, that's on the liability side, so assets, liabilities. So it's the fucking accounting equation, as you all know, very wise apes out here. So what does this mean? What is the exact takeaway for markets right now? Effectively, not really anything. Now, the big takeaway from my perspective here is, why the fuck are you choosing to let treasuries roll off? I don't see who that benefits, or choosing to slow the roll off in treasuries instead of mortgage-backed securities. What I would have done is decrease less the liquidity in mortgage-backed securities markets, because this would have had an outsized impact on mortgage rates, which is going to help a hell of a lot more Americans than the treasury market. Now, you might say, David, mortgages are built on top of treasuries. Who cares? Look at the chart in the piece. The 2-year yield fell off a cliff as a result of this. Mortgage-backed securities and mortgage rates probably, this is pure speculation, probably would have done the same thing and declined quite a bit in response if the Fed was saying that they were looking to get out of the mortgage-backed securities market. But, of course, the Fed wants you to be poor, stupid, and homeless, so we are going to be rolling with that for just a little bit longer. I promise I worded all of that a lot better in the piece, so if you haven't read it yet, go ahead and check that out. It'll probably take you about 3 to 5 minutes. Anyway, let's go ahead and move into some of the stock movers of the day. First of all, we have New York Community Bancorp. This might be one you're surprised to hear about because I thought they went bankrupt months ago, but they are still at it. They were up 28.3% on the day, and that's despite a big fat swing and a miss on earnings. This company, they couldn't have missed less, right? The stock is still down about 75%, even after rising nearly 30% here on the day today, down 75% from August of last year. Losses doubled what they were expected, and this is adjusted losses of 25 cents a share. Those doubled the 13 cents a share that was expected. Sales missed by 18.8%. It was really a terrible, horrendous situation, but the stock went up because the CEO dropped a little bit of optimism in there as well. He basically came out and said that the bank is on a 2-year path to profitability. They don't expect to be bankrupt. Literally is basically what they came out and said, like, hey guys, we're probably not going to go bankrupt. So the stock completely popped off. Expectations are everything. Now, moving on down below, we have Pfizer to talk about. The stock was up about 6.1% on the day, relatively healthy. Now, this company, in addition to being Bill Gates' microchip delivery firm, what they do is, it's a healthcare company, actually, behind the scenes. Outside of all the COVID-19 stuff, they do, a whole lot of other drugs, but the big focus of the market was, of course, on those COVID drugs. Now, we did see COVID-19. I always forget that I can say it because I can't type COVID-19 in the Google Doc here because Google won't send it. But COVID-19 vax sales fell 88% for the period compared to last year. Paxlovid, this is the vaccine pills that the company has made, fell 50%, but Pfizer did come out and reaffirm essentially strong guidance they expected last year. For whatever reason, they're still expecting billions and billions of dollars in COVID vaccine sales. Questionable if that actually happens. If you're still getting a booster today and you're under the age of 120, maybe reassess your life choices. I'm not a doctor. I don't want to tell anybody what to do. Please don't sue me. Don't listen to a thing that I say. But either way, the market was very happy with it, mostly because EPS destroyed expectations at 82 cents a share versus the 52 expected. Let's go ahead and talk about Starbucks here. Pretty much everybody in the world's favorite coffee place, all the smart, wise coffee drinkers out there know that Dunkin' Donuts is the real deal. Absolutely doesn't get better than a black cold brew at Dunkin'. Go ahead and try it and tell me I'm wrong with a straight face. I guarantee you can't do it. But either way, there has been a distinct shortage of daddy's money across the U.S. economy going on over the past couple of months, and that has really hurt companies like Starbucks. So mocha, frappuccino, latte, vanilla bullshit, whatever the fuck, things like that, are in a recession right now. So Starbucks, this is a company that never sees same-store sales decline and never sees traffic decline unless things are getting really dicey. And that's exactly what they saw last quarter. They saw a 4% decline in same-store sales, a 6% decrease in traffic. They cut 2024 guidance quite a bit. Now, if you ask me, if I was a consultant for Starbucks, I would say forget the coffee altogether. Go ahead and pivot into the asset management industry because this company has billions of dollars locked up in customer reward points. Basically, people storing their cash in Starbucks. It's honestly a great inflation hedge if you just kind of store cash as, points for coffee. I mean, one coffee is always going to be one coffee, right? Unless 𝗙𝗲𝗃 figures out a way to inflate that away and starts printing fucking cups of coffee at the Fed. But maybe pivoting into asset management is something that the coffee maker should consider. It's at least their only good asset going for them right now. Very tough scene for Starbucks. I mean, this is one of those companies that has the brand, it has the reputation to stick around for a while. So if you are looking to hold shares long term, this very well could be a good opportunity to get in. We'll be breaking down Starbucks and all the big tech earnings of the last couple of weeks over the next few days. We had a big report for 𝗪𝗲𝗃 coming out that's been taking up a lot of our time over here at the Daily PL Global headquarters. So stay tuned for our report on that. I'll give more detail at the very end. But instead of continuing to get distracted, let's go ahead and move into the final stock mover of the day. So we have chip stocks, or SOXX is the ticker. This is a semiconductor ETF. It was down 3.4% on the day, and that's a big move for an ETF. And a big reason for that was the absolute mauling that happened to companies like SMCI, or Supermicro Computers, and AMD. Both came out with less than impressive earnings on the day, and that completely tanked the market. When I say less than impressive, by the way, Supermicro sales grew 187% compared to last year, and adjusted EPS grew 307%. Bullshit. Not good enough. Not good enough for Mr. Market absolutely is the case, because when you're potentially in a bubble, it doesn't take a whole lot to pop that bubble. It's not a lot of force that you need to go ahead and pop these things. Just ask SpongeBob and Patrick. We all know how difficult it was for them to teach Squidward how to even blow a bubble. Imagine how easy it is to take one apart. Now, gross margin did fall at the same time for SMCI, so that was kind of the big hit. It fell from about 17 to 15%. Don't know if that warrants the 15-20% decline that the stock saw. AMD was down in the high single-digit percent on the day. I didn't look it up before starting this, like I probably should have. Anyway, let's finish up talking about some insecure consumers here. So, most people in the United States, there's a stat out there, I'm pretty sure it's been debunked, but it says that most people don't have like $400 in their bank account, $500, might be $1,000. I don't really know what it is, but it basically says that more than half of Americans don't have enough cash to handle like a surprise $500 expense. I'm pretty sure that has been debunked. I didn't look into it too much, obviously, because why do any research? Right? Just come on here and start yapping. But, effectively, we're going to ask this group of people who barely knows how to tie their own shoes what they think about the economy going forward. So it's no surprise to see that they were a little bit nervous. We see consumer confidence is currently at the lowest level since July of 2022. So this is from a conference board survey that was released on Tuesday that we're just now getting a chance to talk about here. Overall consumer confidence declined about 6% compared to March. So the April reading that we saw was about 97.0. March was at 103.1. So that's about a 6% decline. That wasn't the big problem, however. The big issue was in the spread between the present situations and the expectations index. So expectations index was really the one that crashed quite a bit. It was down about 10.2% for the month, down to 66.4. Now, it's a little bit different for the expectations index. Nobody ever thinks that things are going to be good down the line. So, you sound smart when you're pessimistic, and you kind of sound like an idiot when you're an optimist. So that's why I sound so stupid all the time. It's obviously not because of the things that I say. But we are seeing the spread between the present situations and the expectations index increase quite a bit. That is definitely not going to be a good sign, because when we expect our future to be significantly worse than our present, in economics, we do have the ability to create that reality. If we say, no, we got to save up, we're all going to stop spending, then the economy is going to, earnings are going to grow less, job cuts are going to follow, and then wages are going to start declining, leading to less spending. This is kind of how the cycle goes. So expectations really do drive everything. That's why we're talking about it here. Besides the fact that, economists, consumers, nobody knows what the fuck's going on in the economy, but we're all just out here swinging and missing as usual. But hopefully this decline in confidence is one of those misses. We'll see going forward. Just keep your fingers crossed at the end of the day. All right. Well, let's finish up with a quote here. Oh shit, I didn't put in a quote. But you know which quote I was going to put in here today? It's a Jesse Livermore quote. We haven't talked about Jesse Livermore in a minute, so I wanted to put in one of my all-time favorite quotes. And he once said, it's reported that he said in reminiscence of a stock operator that speculation is as old as the hills. There's nothing new on Wall Street because everything has been done before. That's essentially the essence of the quote. It's similar to a biblical quote, like that's something like there's nothing new under the sun or something like that. Basically just saying that, history repeats itself, it rhymes. What we've seen in the past, we're going to continue to see in the future. And what we're seeing right now, we've seen certain iterations of in the past. Really nothing new going on because human nature stays the same throughout time until, maybe evolution is going to change that over the course of hundreds of thousands of years. But, we live in the right now, and unfortunately, we're only going to be around here for about maybe a century if we're lucky. So, it's just getting used to human nature and how we can adapt that to our certain situations. Anyway, guys, that about does it for us here today. Like I was alluding to towards the middle there when I was rambling, like always, we do have a new equity research report that's going to be coming out over the next couple of days. This one is on Enphase Energy. It is absolutely top-notch. You guys want to see it? Let me go ahead and pull up a little bit of a preview right here. So this is what the front page looks like. Hang on, if my mouse would ever appear. There we go. Okay. This is what the front page of the report looks like. I don't know if you guys can see it too well there or if the glare is coming in. I definitely don't want you to be able to read it, but yeah, you can kind of see it right there. We got some cool charts as well. So as of right now, this thing is about 23 total pages long. That's including the appendix. This is on a $15 billion stock. So definitely stay tuned for all of our thoughts on this. Go subscribe to WSO Alpha if you want to be cool and join the rest of us. Otherwise, you are basically dead to me. Anyway, happy investing, happy trading. Hope everybody has a great rest of their week and a wonderful weekend. I will see you tomorrow back with your regularly scheduled programming. Have a great one, apes. Bye now.